Hello and welcome to the final Mint Roundtable conversation. Over the last 2 days, you've been hearing some very, very rich conversations and debates in the run up, of course, to the big event, which is the union budget. Now, a little bit debatable, I suppose, because of how policy has been running year round. But yet, it is a bit of a signaling mechanism for markets, for economy watchers, for all of them. This time, in this conversation, we're really getting down to the essentials and the brass tacks of it. What is it that the economy needs at this point? Where have we gotten to, frankly, in terms of the crisis that we've ridden through for 2 years now with COVID and the pandemic? And more importantly, that big question of a $5 trillion economy, at this point, standing just a shade over $3 trillion. So looking a bit difficult, honestly, but let's let out or plot out what the next few years may look like. There has been, to be fair, promise and performance from some sectors over the course of the last few months, but equally, there remain very, very large patches of concern. And that's something India, as an emerging market and with its own unique challenges, will have to deal with over the course of the next few months. Let me, without further ado, introduce my panel that's going to be discussing just that through the course of the next hour. Lekha Chakrabarti, who's professor at NIPFP, will be joining in. We're trying to get everyone together from different locations, still working with the pandemic situation. So you may have some video disruptions. Our apologies for that. Ajit Ranade, who's chief economist at the Aditya Birla Group. Anant Narayan, who is assistant professor at the SP Jain Institute of Management and Research. Yamini Iyer, president and CEO at CPR, Center for Policy Research. And Sajid Chenoy, chief economist at JP Morgan. There is a serious amount of economic heft on the screen right now. So prepare for a really deep down conversation about where things stand. Ladies and gentlemen, thank you so much for joining in. My first reaction was that perhaps 1 hour would not be enough in terms of the conversation that we're going to get going. So I'm going to really be rat-a-tat-tat with my questions. Sajid, first shot with you, really. We spoke in January last year, Sajid. There's a sense of deja vu, of course, about the situation with the pandemic. But how are you feeling on some of the key parameters in terms of where we stand with growth? And how worried are you about the fiscal situation, which is going to be, a key sort of weather vane for the union budget?
Thank you very much, Mitali. Lovely to be here. 1 year out from when we last spoke, I think we've seen encouraging progress, but we have to keep judging ourselves by the right speedometer. We're back at the pre-pandemic path of activity, but really what we need to aspire to is to go back to we're back at the pre-pandemic level of activity, but not the pre-pandemic path. So we have to keep, if the pandemic hadn't happened and the economy had grown at 6.5%, what would the level of GDP have been? And where is the level of GDP today compared to that counterfactual path? So even though we're back at the level that we were in March 2020, we're about 6% or so below that path. And that has to be the focus of policy in the next couple of years, closing that gap and getting back on that path as soon as possible. I would argue that while 2021 was the year of getting activity back on track, 2022 will have to be the year where we get jobs back on track, because the employment to working population ratio is still a couple of percentage points below where it was in March of 2020. Now, I think this is where fiscal policy becomes very important, because I think the important lessons learned from the last financial crisis was fiscal policy around the world tightened too quickly, choked off the recovery in many economies, and it took 36 quarters for the global economy to go back to close the output gap. That wisdom has been revisited. And I think there's a consensus around the world that given patchy, uneven recoveries from COVID, fiscal is much better suited to tackle that underperformance vis-a-vis monetary policy. And so the balancing act for me for the budget is the following. And on the one hand, I think the budget will still have to keep demand relatively elevated. I've been saying for a while that private investment will take time to recover. And so public investment will have to be, shouldering the burden of job creation and keeping demand elevated for the foreseeable future. That along with, automatic stabilizers, whether it's providing resources for NREGA or providing more targeted support to the informal sector. The challenge is we're living in a much less benign global environment. The Fed will be raising rates, 4 to 5 times this year. We've seen what's happened to US bond yields. We've seen the spillover effect on India's bond yields. So for me, the balancing act is how do you keep demand supportive in the near term while laying out a credible medium term consolidation path? If we can get that balance right in this budget, we would have been able to, support both growth in the near term, job creation in the near term, without compromising medium term macroeconomic stability.
Dr. Ranade, let me hand the baton to you. Sajid raises an interesting point, about the fact that demand needs to be pushed, which I think, is a point which has been labored on for many quarters now. Though we didn't get the amount of fiscal stimulus many other economies did, do you think it's going to be a this time is different? And secondly, how do you read the level of pain that seems to exist at the household level now, where it is clear that demand has been stymied quite a bit because of the situation that we're living with?
Well, Mitali, the story of the K-shaped recovery is now fairly well accepted. So on one hand, our GST collections are doing well. Corporate profitability is very good. Corporate balance sheets and banking balance sheets are in much better shape. Our exports are going to clock $400 billion this fiscal year. FDI flow has been strong. The stock market, of course, as you know, there's ups and downs, but it's overall very strong. The story of 100 unicorns. That's the upper shape of the K. And the bottom, that's where much of the bulk of the GDP is coming from. If you want to break it up, I think 60-40, 70-30. But much of the population is in the lower part of the K. Whether, as you just now said, the labor force participation rate is barely 40 or 42%, very, very low. These are people, workers who are not even discouraged workers, not even looking for work. The high demand for continuing high demand for NREGA, the fact that the Prime Minister's the Anna Yojana, the free food rations had to be extended all the way to March 2022. So it's 2 full years, the largest free food distribution scheme in the world. Then, of course, the fact that, because of elections in the 5 states, a lot of populist. So this is where we are. The K-shaped thing makes it difficult. That is, are we going to acknowledge the fact that actually there is a fairly good sign of robust recovery? Incidentally, as Sajid said, the story so far until the pandemic was investment to GDP stagnation. But actually, the advanced estimates for this year are showing 36% investment to GDP ratio. It's too early to say, but I think if that's the trend, then we're going to see a lot of capex coming in beyond the infrastructure capex of the government of India. So the fiscal stimulus that we need, I guess, is to ensure that the consumer spending at the sort of relatively lower incomes, that's where we need the rural spending. That's where we need the consumer. The fiscal stimulus to operate. There are many ideas there, but of course, fiscal space is not unlimited. By the way, last year the 6.8% was already a high number targeted. And I believe we are going to probably do better, but not much, 6.6 or 6.5%. So this year, in any case, the expectation is that the fiscal deficit is going to be 6% of GDP, which is far above 3% as targeted by the original fiscal responsibility legislation, and far above 4.5%, which the finance minister herself targeted last year. So 6% is already high. I don't know how much more we can do. So that's what we should expect. But some amount of consumer stimulus is there. But I think there are signs that we are going to see a capex revival. And to just one more point, what Sajid saying, the global scenario, I do agree that the Federal Reserve Bank tightening presents a challenge. I do agree that the geopolitical flashpoints like Ukraine and maybe Taiwan are something to worry about. And high oil prices will always put pressure on our fiscal subsidies and the exchange rate and the current account. But not to forget, 2 of the largest economies in the world, China and USA, are growing at 5% or 5.5%. That's 40% of global GDP. I think that's like a boom time. So that's why that's reflected in our export performance. So I think there are good signs, and we will continue to see good foreign inflows into especially our unicorn. So there is a bright side to the global economy, at least which will sustain for possibly 1 or 2 years.
There is good flows, Dr. Ranade, but most of it, as you said, seems to be going into the tech side of things, not into manufacturing, not into the nuts and bolts that we need. Of course, on fiscal deficit, that's 6%. I mean, center and state, I guess, would be somewhere closer to 10.5%. Anant, the same question to you, just restructured a little bit. The last time we spoke, it was a Ye Dil Mange More budget wish list from you. Are you feeling as expectant this time round? What do you want to see on the 2 points that you've heard? Do you expect to see much more push on demand? Do you expect to see much more laid out by way of capex intent?
So let me add to what Sajid and Ajit have already mentioned, and I agree with them that one key metric that I think is the lowest common denominator of all our macroeconomic issues is employment. You know, by the way, this 43% that Dr. Anade mentioned is our employment to population ratio right now. Used to be 55% in 2005. It's been steadily coming down since then. CMI data suggests that the total workforce in 2016 December was 40 crores. It remains practically static at 40 crores in 2021 December, right? In 5 years' time. And by the way, within that, manufacturing and services jobs are down by 1.5 crore at a time when we should be adding 1.5 crore, 1.2 crore jobs every year. The reality is we've done a lousy job of creating jobs. This predates one government. It's an issue, structural issues over the last 15 years. That is the issue which needs to be addressed. If we have jobs being created and a virtuous cycle of jobs, salaries, savings, consumption, investments going through, we can do what China did, which is actually grow at a very good pace and at a sustainable pace. And frankly, things like fiscal policy, monetary policy will not matter as much. So to me, the bottom line that I'm looking for from the budget is how do we actually facilitate the creation of jobs, right? And it's a medium term project, but it has to be done. Few things there. One is, some of the plans are right. For instance, Atmanirbhar Bharat, your production linked incentives, trying to get manufacturing of Philip, your labor laws, which have to be notified, but hopefully they get notified at some stage, your tax cuts, trying to ease investments into manufacturing. I hope that thing works. We need that thing to work. As a precursor to that, you also need investments into infrastructure. You have the National Infrastructure Plan, a grand plan for 111 crores, 11 lakh crores. Question is there enough financing going into that? So is more capital expenditure being set aside by center and states? More importantly, are you monetizing some of your assets? Now, here is where there's a question mark, Mithali. We were supposed to privatize 2 nationalized banks. We were supposed to privatize 1 insurance company. LIC IPO hopefully will happen. All of this essentially has to happen for us to start channeling money into infrastructure and therefore build this manufacturing edifice. So to me, that's one big issue. Second thing, we know that, Ajit mentioned the banks are in a better state, but there's still a lot to be done. We were supposed to have a bad bank by now up and running. We were supposed to have a development financial institution which can facilitate infrastructure creation. We were supposed to cleanse the power sector. We've got a plan for cleansing the power sector, which is a kick can that we've been kicking down the road. That needs to be cleaned up as well. So, to me, the bottom line I'll be looking for through budget and the UP elections is the focus that the government promised last time: privatization, trying to put in more money, getting more private sector participation. Does that slow down as the farm laws did? Or do we see a continued impetus and the continued success and hopefully the success of things like PLI? Do we create jobs in this country? That's the bottom line. Now, on the fiscal part, which Sajid very quickly mentioned, look, there is a problem. While last year the center came out clean and took a lot of off-balance sheet items onto the books, therefore presented a real picture. Reality is there is still a lot of pressure at the states. States will get less than 30% of gross tax revenue this year compared to the 41% that the Finance Commission has promised. And by the way, all the holes that used to be there at the center in terms of off-balance sheet items, there are lots of items I suspect in the state level. Discoms is a prime example, public utilities and transport is a prime example. So there is very little fiscal space. There are lots of holes and things in NHAI, PFC, REC, Discoms, which are all hidden. So therefore, the need for money will remain. 2 things on that particular score. One is I'm hoping that the current trend of formalization, which has improved tax collections, Ajit, I think, or Sajid mentioned higher GST numbers. I hope that continues. Second thing, one thing Mullah ki daud masjid tak, I'm a markets guy. I'm hoping that this bond index inclusion comes through, which will be one way in which we actually get flows coming into the market into funding the fiscal deficit, and therefore funding. Otherwise, you'll have a trouble borrowing program. So bottom line, Mithali, I'm hoping for jobs, and lots of things need to happen for jobs. There's no magic around here. Lots of things need to happen. And second, on the fiscal side, yes, we do need money for infrastructure, and I'm hoping we manage to draw in some savings from overseas through this index inclusion.
Anand, for a bond wala to say the global That's coming through is like an equity wala saying this year we'll meet our divestment target. I think you and I can keep going on till the cows come home on that one. But Yamini, this is an excellent segue for my question to you. You and I have spoken through the year about jobs, jobs, jobs. And here we are. The preliminary trend seems to indicate that already demand for Narega is very high. There was so much talk about an urban Narega scheme. We didn't hear anything about that. And as Anant was pointing out, now we've got a third wave with COVID where more services jobs must have fallen out of the net. Uh, that this is an acute situation is clear to everyone, but what is it that we want to hear now as next steps?
Before I get to next steps, just want to add one more complexity to the challenge that we confront today, which is that you're also talking about new entrants that are going to enter the job market, with educational institutions having been closed for the better part of 2 years, and critical skills not being provided. Here, there's a twin problem. There's a long-term problem of human capital accumulation that will be significantly affected by learning losses at the primary level. And then there's the immediacy of our undergraduate courses, for example, are 3 years, which means 2 of those 3 years for anybody that started university at the start of the pandemic in 2020 has basically not been in classrooms. And as a consequence, there's always been a skill mismatch in the formal organized sector between of the labor market, and I suspect this is going to be accentuated. So any discussion on jobs going forward has to take into account that the skill deficit is going to be even more, and we need to be able to address that in the short term to before we can really look at the longer term challenges of labor market that the Indian economy confronts. I think I want to say two things. Last year in 2021, when the finance minister presented her budget, there was my reading of the budget was an underlying assumption that we were past the worst of the pandemic, and therefore we had to focus on recovery and not necessarily on relief. So you saw a scale down of Narega, you saw also an expected scale down on food subsidy, and you didn't see much of a hike in investment on health at all, in fact. And it turned out through the bulk of the year that in fact that's not the case. And as she presents the budget a week from today, she's presenting it in the midst of a third surge. So I think it's very important that we break down the challenges that the Indian economy confronts into recognizing that we're still not past the immediacy of the relief stage. And therefore, a certain amount of immediate spending is going to be necessarily continued through this uncertain period. And I suspect this uncertain period is going to be uncertain for a while. And therefore, we need to look at increased expenditure, regardless of its impact on the fisc, when it comes to basic social protection that we already have in place, so public distribution system as well as Narega. And the mistake we made last year of scaling down Narega has had a huge impact on the field right now, because there's automatic demand rationing on the ground when there isn't enough stated budget available in the national budget. So we may say that Narega is a demand-driven scheme and therefore money will come over time, but it doesn't quite work out like that for practical reasons. I think to address the challenge of the fisc, I'm not blind to that. It's very important for the government to present a medium-term fiscal battle plan, which we do not have. We said 4.5% following what the Finance Commission said, but how do we get there? And recognizing that there is going to necessarily be elevated spending, being honest and clear and transparent, as the FM has been on the EBR, on the extra budgetary story, is, I think, going to be a critical thing that I would look for in this budget. One last point, over these last 2 years, on critical elements of Government of India spending for the bottom half of the K, you've actually seen a lot of contraction. School education, for example, budgetary allocations were 20% less in 21 over the BE of FY 1920. Actual utilization of money was very low. Only 20% of the overall available budget has been spent in the first 8 months of last quarter. This is data that my colleagues at CPR have just pulled together. Similarly with ICDS, similarly with Jal Jeevan Mission, and there was a logic to that. Perhaps you needed to do some expenditure switching because there were elements of immediate social policy protection prioritization, Narega, for instance, PDS. That world is going to change. I hope to God that we're not in a world 1 year from now where schools are closed for the third year. Presumably, schools will open at some point. Regular expenditures will need to take place and more. So we are not in a comfortable position. I think we should expect to see fiscal deficit rising, but with a battle plan, so that once things start coming back to some degree of near normal, we also then can scale down expenditure in sensible ways. So those are the two things that I would look for in this budget.
Yeah, no, absolutely. And I think my bigger concern around education, Yamini, is the fact that it is not even considered a problem. At least with health, there is a first step where you say, yes, we have this problem. With education, it doesn't even exist. So many of the spot surveys show that children in class 3 or 4 now cannot string two syllables together to make a word. And then, we want to set up more ITIs. I think that is the irony of the situation. Lekha, just one, question to you on this fiscal deficit so that we can, then put it aside. What is your own view of what might be signaled for the next year in terms of a fiscal deficit? Because I'm seeing very wide variations, including some really fantastical numbers like 5%. What do you think the finance minister will choose to do? And as an extension of that, how do you think credit agencies will now read that? Because last year it was seen as quite positive that she'd put all her cards on the table. She was trying to clean up the mess that existed with the fisc. This year, what do you think people are looking for?
Yeah, absolutely, Mithali. That the deficit is good. That will be the narrative of the upcoming budget. That's my strong feel. Because last year also, finance minister gave the clue that you don't have to fear deficit in the time of pandemic. So maybe in this budget also, I think this will be the narrative that we don't have to fear about budget deficit right now or the fiscal deficit right now. And even when you look at the economic survey and the in the closed circles, the narrative is that high fiscal deficit can be substantiated if we are using it for increasing the capital infrastructure and also to increase the required revenue spending, including education and health. So if we can protect that narrative in this budget, nothing like it. But on the other hand, the counterfactual is if we go for, a kind of fiscal consolidation this moment, it could be adverse to the macroeconomic recovery because this macroeconomic uncertainty, it's mounting. It's even we cannot even measure this macroeconomic uncertainty. And as you mentioned in the preliminary round, in the initial when you opened in your opening remarks, you mentioned about the global challenges. That itself is a huge challenge for the upcoming budget. We don't know what's going to be the taper tantrum dynamics. We don't know what exactly is going to happen with the Fed Reserve. So there is a mounting pressure on RBI also to increase the interest rates. So given this uncertainty from the interest rates, from the inflation is also mounting. Now, despite doing all this heavy lifting, monetary policy could not do that one-to-one, what you call the dynamics with the growth recovery process. So when the monetary policy stance, despite doing all this heavy lifting, I'm not talking about even the normalization procedure, but when there is a, huge limitations in this credit infusion mechanics, then, fiscal policy has got a major role to play because the credit infusion mechanics is not working at all for the growth recovery. So my hunch is, the fiscal deficit, we are trying to make it around 6.8. That will happen because that consolidation path is going to be through the tax buoyancy, not through the expenditure compression, because we are seeing that the taxes are buoyant. Of course, it's a high frequency number. We need to see the long-term trend. But the other sources of revenue, what we have floated last time is a privatization proceeds. But in the whole revenue budget, privatization proceeds, even if our aspiration is correct, even if that fiscal marksmanship is correct, it is only around 5% in the entire, revenue budget. So we need to see whether the taxes are buoyant because revenue compression or the expenditure compression, revenue expenditure compression, especially social infrastructure, that will be detrimental if we go through that path. So let's talk it about fiscal consolidation as a medium term, not as an instantaneous solution.
Sure.
Yeah.
Sachit, I want to delve a bit deeper on the inflation issue, which for the RBI has remained transient in nature. But as we have seen through the course of the last year, there is the immediate impact of inflation and it doesn't go away. The follow through carries on for a couple of months. This especially for the the bottom end of the K that we've been talking about. How worried are you about that? Because just to add, here's also a situation where corporate India has now started saying we haven't lived with this kind of inflationary environment in a really long time. It is making business tough.
I mean, that's a great question. This is something the world is grappling with. That what we're seeing on the one hand is, global supply chains that have been disrupted, and every time there is a belief that these disruptions will gradually unwind, another wave is upon us. Frankly, over here, I think the China zero COVID policy is not helping, because every time China shuts down provinces and cities and factories to try and get to its zero COVID targets, it kind of disrupts global supply chains. You see, the inflation we've been seeing in India so far has been, like many other places, high goods inflation, not so much services inflation. And the thinking was that as the services economy opens up, you should see a switch here, that services inflation might pick up as demand for services becomes inelastic. But presumably the goods inflation will disinflate because supply chains would have become normalized by then. Unfortunately, 2022 has begun with more pressure on goods inflation. Oil is now close to $90 a barrel. No sign that supply chains have completely unwound. So we could be in this uncomfortable mix where the supply services economy is opening up, services inflation is picking up, and we haven't got higher goods disinflation. The problem with emerging markets, and a little bit of a challenge for the RBI, is inflation expectations have picked up, by almost 200 basis points over the last year and a half. Because the expectations are adaptive, they're backward looking. So the longer you live with, 5 to 6% inflation, the harder these expectations get, and that in a way makes the trade-off between prices and slack more uncomfortable. Bottom line is, I think many emerging markets, India including, will now have to prioritize policy. As I've been saying, 2020 and 2021 were the years where both fiscal and monetary were reinforcing each other, understandably so, to jointly mitigate the damage from COVID. But if inflation is going to be sticky in the 5-6% range, with the current account widening a little bit, oil climbing, policy will have to prioritize. My own sense is fiscal should remain relatively accommodative for all the reasons that have been laid out, over the last half an hour. But precisely because fiscal is going to be slightly accommodative, monetary will have to begin to normalize. Now, to the RBI's credit, they've done a very adept job, I think, in the last 6 months of trying to normalize in a non-disruptive manner. But that will be the challenge going forward, that given these global headwinds, how do you normalize monetary policy non-disruptively, even as fiscal policy remains relatively accommodative? We go from policy reinforcement to policy prioritization, from fiscal and monetary becoming complements to substitutes this year.
Dr. Nanadi, the point was being made earlier about the fact that tax collections have been very strong, and they genuinely have been very buoyant, of course, in part to do with petroleum products. Is it a necessary bygone, though, that the fact that there is more revenue will naturally mean there is more expenditure? And if you believe the answer is yes, in which direction do you think the thrust is going to be? Will it continue to be the hard infrastructure projects? Do you think some amount of attention will move to social infra instead? Will services get the kind of support that it most urgently needs?
So first of all, thanks to inflation, the estimate of nominal GDP growth rate last year in the budget was about 14%, and it's going to be 17%, 3 percentage point higher, which is quite fantastic. That's one of the reasons why the fiscal deficit ratio is going to look good. Secondly, GST collections have lately started hitting 1.2, 1.3 lakh crores. And one of the reasons for that is that imports are climbing at almost 50%. Of course, exports are doing well. So GST on imports is a very important contributor. Then you mentioned the excise on petrol and diesel, which of course went up sharply. But before the elections, I think partly because of electoral pressures, the excise duties were reduced. So to that extent, excise collections from petrol and diesel will be lower. But of course, they're already near 3 lakh crores. So maybe they'll come down to 2.5. So it's still significant. So I think the fiscal situation because of this is looking, according to me, quite okay. However, still half of GDP is outside the GST net, despite all this. Of course, GST Council decisions are outside the union budget, but there is scope to widen the GST tax net and actually even make this tax collection situation better. So therefore, when we look at spending priorities, I agree with what Yamini said earlier. Obviously, we got thoroughly exposed in terms of our unpreparedness as far as the healthcare infrastructure is concerned. I know that health is also largely a state subject, and so is education. But the center will have to step in. So that's one priority on social sector spending. Secondly, GST compensation to the states. The June 22 is the end of this 5-year compensation formula, but the states are nowhere in a situation to be able to carry on by themselves. So there'll be a demand for GST compensation to continue, and that will have to come from tax collections. That is, something a center's obligation. It's a political discussion, but it's a center-state federalism issue. But I expect that is also something that the union budget will have to make arrangements for that. And of course, two other things. One is the recapitalization of banks. So banks are in good shape, but if you want to support high credit growth, you need to capitalize. We still have a 70% public sector banking. We still have 51% of ownership from the government. So while we heard a lot of criticism of UPA level oil bonds and how the oil bond repayments are becoming due, the same thing is going to happen to the bank recapitalization bonds. But we need them. And then lastly, of course, the capex on infrastructure, the national infrastructure pipeline. Remember, we are expecting, or we want 20 lakh crores annually. That's the kind of huge, we've never seen this kind of execution of such large level capex. And a significant part of it will have to come from the central government. I think at least about, 5 or 6 lakh crores. So there are plenty of demands on spending priorities.
Anand, ultimately, of course, the budget becomes, two things. One is a tax document and the other is the borrowing calendar, on which also there was a jolt last year because the borrowing calendar just suddenly went awry. What do you expect to see, on that front, and how nervous do you think the market is about borrowing figures?
It's a great question, Mitali. So look, the center this year was budgeted to borrow on a gross basis about 12 lakh crores. For the next year, if they target a 6% fiscal deficit, which is what I think will come to, roughly about 6%, you'll probably end up with about 13 lakh crores of net borrowing or gross borrowing at the central level. More importantly, you also have borrowing at the state level. As Ajit was mentioning, there is going to be a hole in the states. Their revenue growth is nowhere close to what the center is experiencing. Plus, there is this issue of GST compensation, which will lie between the center and the states. Overall, center plus state, your gross borrowing requirement might be as high as 22 lakh crores. Net borrowing would be about 16 lakh crores. Generally, Mitali, between banks, LIC, pension funds, insurance companies, and such like, you would have demand for about 10 to 11 lakh crores on a net basis. That's a regular demand which can come through. So you are looking at a potential gap of 4 to 6 lakh crores, depending on your math, which is why the point I made earlier about index inclusion becoming crucial, because China's experience tells us that when they managed to get index inclusion, they actually got decent amounts in. Estimates by JP Morgan and Stanchart and others suggest that the country could get between $20 to $30 billion if you actually got index inclusion. So that's one crucial element which is required. Finally, there is a buyer of last resort, which is the RBI. The last couple of years, the RBI stepped in, both through direct purchases, as well as infusing liquidity and nudging banks to buy by giving them dispensations on HTM, hold to maturity, and all of that. Governor called it a public good and almost enjoined every bond dealer to go and buy bonds. So that is always the last resort. That if you have a tough borrowing program, then the RBI activates itself and starts to manage the borrowing program. But that goes back to the point that Sajid was mentioning. That's where the tension comes up. There is an inflation problem. And by the way, a lot of the inflation problem is supply side and supply chains and chips and import costs and all of that. There is also a monetary side to inflation. The fact is, all this fiscal deficit has created money. M1 growth, Mitali, which is current account, savings account, money in circulation, over the last 2 years has grown by 17% per annum. There is a tremendous amount of free, narrow money lying in the system, which is lying there because guess what? There is financial repression of rates. Your inflation expectations are at 12% as per RBI surveys. Weighted average deposit rates are at 5%. So at minus 7% real rate return, we've got to have rocks in our head to put money into fixed deposits. So all that money is sloshing around, looking either for assets to buy, equity markets, bitcoins, what have you, or going towards consumption, and which is going towards high value consumption and imports. So there is it's a balance that the RBI has to strike. I suspect they'll try and do both, which is manage the borrowing program, at the same time allow for bond yields to go up and therefore try and bring some balance. It's going to be a tough time. Ultimately, Nali, it boils down to this: does the overall budget and beyond the economic policies actually help foster jobs, has actually helped push money into infrastructure, and therefore bring some kind of a virtuous cycle? If we get that in place, frankly, all our macroeconomic issues will be resolved over the next 5 years. But implementation is going to be bloody difficult. Whether it's privatization, national infrastructure plan, not easy. Easy to put this on paper, difficult to implement these.
Yeah. Yeah, no, I'm going to get to that in a bit. Yami, I just wanted to go back to a point Dr. Ranade was making, and this is it's a larger point than the budget, etc. I think, which is on the federal structure and how things are working right now. The fact that the state share of gross tax revenue, as was being pointed out, is below 30%. Yesterday, we were having a conversation about manufacturing, where most people came on to say, look, finance is no longer a problem for us, but here's the problem for us. What the state is saying is very different from what the union government policy might be, and ultimately, our project has to be set up in that state. So, we're talking at cross purposes to too many different parties. This has actually gotten accentuated over the last couple of years. I mean, that's clear for everyone to see. How do we find a way around that? Because that seems to be a stickier point for industry than anything else.
Yes, absolutely. I think the trust deficit between center and state is at an all-time low, and it's a serious challenge going forward, especially in light of, as Ajit pointed out, June 2022, when the compensation cess does need to be renegotiated. And there is going to be a requirement both of center and state to show a degree of political maturity in arriving at a sensible compromise against the backdrop of much that has happened over the last 2 years around the compensation cess as well. And my own sense is that, states are really ready to hold the center or to ransom on this one. And the center hasn't done itself any favors by undermining the compensation cess process over the last 2 years to make it very difficult to arrive at an appropriate consensus. Equally, last year's budget did a lot of damage towards the goal of building trust. It did so through these impositions of cesses. So not only have we had they reneged on some of the on elements of the compensation cess, there's also the lack of the reduction in fiscal transfers to states in terms of their share, devolution share. The imposition of cesses just added to it. So the agri-infrastructure cess, the increase in import duties, which are not shareable on certain items, which are not shareable with states. All of that has created a context where states feel consistently, and rightly so, that they are commitments towards them, rightful commitments, have not been fulfilled by the center. Added to that, what I said earlier, for a lot of social policy expenditure, social sector expenditure that has been at the front and center of state spending in the last 2 years, states are dependent on centrally sponsored schemes from the center. And the center has, except for some which have been prioritized, it perhaps because of the need for expenditure switching owing to the pandemic, has actually reduced a lot of that spending as well. And that doesn't show up very easily in budgets because we don't have plan, we got rid of the plan, non-plan, etc. And so states have lost out on a lot of money that we don't necessarily discuss often. All of this together is adding to a significant stress on state finances. So the challenge going forward, I think one important way by which this budget could perhaps set the ground for what the big sort of debates that are going to take place halfway through the year in June over GST compensation cess is to at least refrain from, if not reduce, its tendency of introducing and increasing cesses and surcharges, which are not, I repeat, not shareable with states, and as a consequence, reducing the overall gross tax revenue which are rightful rights of states as part of the fiscal federal architecture.
Yeah, someone was mentioning Land Reforms Act. I mean, now we have several versions of that across different states. Sajid, this is a more, I don't know, naive question, but how long does an economy function in this K state? Passenger vehicle sales are up, two-wheeler sales are at a 10-year low. Gold sales are up, gold loan defaults are increasing. Non-essential housing is up, but we can see the stress and strain that's happening for the middle and low income. I take your point about contribution to GDP not being that great for the bottom part of the K, but where does that leave an economy or a country in terms of what it looks like?
Is that for me, Mithali?
That's for you, Sajid.
Yeah. No, I was going to say, you raise very important points that we need to be looking now not just at aggregate shortfalls in terms of levels of GDP, but the distributional effects are clear. And I don't want to, sound overly simplistic, but in my mind, this comes down to jobs, right? So if you look at consumption, for example, and look at where consumption is compared to pre-pandemic parts, there's a meaningful shortfall there. If you look at the RBI's consumer confidence surveys, people are wary of future consumption, rightfully so, because at times of high uncertainty, when there's future income uncertainty, you typically run up precautionary savings, and your inclination to borrow is much less. So I think the first thing that policy should endeavor to do is create job certainty and income certainty. Now, this is not easy to do. It's not easy to create jobs, which is why what all of us have been looking for is for public policy and for fiscal policy to create a catalyst. If you go back to GDP as being C plus I plus G plus X, I'm going to avoid too much ghibli gob. There's a belief that private consumption and private investment will bounce right back after the pandemic. But in fact, given this once in a 100-year crisis, those elements of demand will take time to recover. Right? Private utilization, investment utilization rates are in the 60s. Private investment will time to recover. Consumption will be a lagging indicator. You first need job creation and job certainty, which is why if C and I will not be leading growth, G and X have to create a near-term growth bridge. And spending on infrastructure, spending on health, spending on education will presumably create some jobs. You'll create some construction jobs, you'll create some service jobs, but hopefully have a catalytic impact. That if you this enough spending over the next 2-3 years on physical infrastructure, presumably utilization rates for various sectors will rise, and then there'll be an incentive for private investment to pick up, and that will create more jobs. So this is not an easy situation. I think many emerging markets are facing this, coming out of a once in a 100-year crisis. Emerging markets didn't have the kind of fiscal space to expend that the US, for example, did. And so this is going to be a difficult, challenging few years. But I think we need to understand the context in which policy is applied. So I would argue, over the next 3 years, have a medium-term plan, continue down the path of higher public investment, health, and education. I think the global economy gives us a lot of opportunities. We do believe, unlike the last financial crisis, global growth will be very strong in 2022. So if exports can begin to pick up well, there are two drivers of demand. And presumably, if some of the healing can start through G and through X, we can gradually see C&I recover over time.
Lekha, we're also in a situation where there is a political reality to, when this budget is being presented, which is that there are many key states going into elections. Do you expect to see or hear a very overt tilt in terms of the decisions that are announced in the budget that may be facing towards some regions more than the others?
Yeah, last time also we tried this trick, like how can we manipulate the calculus of consent at the state level using the union budget? There were evidences last time as well that, in the state of Kerala and Bengal, in terms of certain capital infrastructure announcements were done by the union budget. So this political economy of what do you call triggering or incentivizing the calculus of consent that happens, but that didn't work actually. When you look at that the toolkit of union budget using as a calculus of consent trick, that will not work. Rather, what works is what will be that narrative of the union budget, whether it is going to be giving emphasis to employer of last resort policies, or whether it is going to give emphasis to cash transfers or basic income, triggering the basic income into the hands of people. I do believe that emphasizing employer of last resort policies, so strengthening the employment policy, that's going to give more mileage than this clientele based announcements or populist measures that's going to be using budget for that kind of a political economy. Yeah,
Hmm.
Mitali.
Anant, you got to talk about your favorite market. Now I get to talk about mine. What do you want to hear? Or I don't know. What do you even expect with asset sales, right? The shortfall from last year, I think for most people is they're penciling in a pretty large figure, 75,000 to 1 lakh crores. You want to hear more details about what already exists, like the banks or LIC, or do you want to hear something else? And, secondly, how much importance do you think the markets will give that figure anymore?
Right. Look, so this year is clearly going to be a challenging year in terms of divestments. We know that 1.75 lakh crores was the budget. It probably end about 1 lakh crore short, and that also depends upon something happening on LIC in March and all of that. I think that there'll be a reiteration of a largish target for both divestment as well as asset sales for next year as well. The point is, we do have an aggressive national infrastructure plan, and a financing of that has to happen, which means you do need to generate resources, and divestments and asset sales and monetization will be a path towards that. So they will have no choice but to announce a largish asset plate sale plan, maybe 1.5 lakh crores, between 1.5 to 2 lakh crores again. People will shrug their shoulders and say, haven't we heard the story before? Now, to be fair to the government, there have been realistic issues over the last few years. I mean, there's been COVID, it's never easy. You can argue markets have been up and therefore it's easier to monetize. And plus, things like changing the laws for allowing privatization of public sector banks, these are weighty issues which need to be debated. So I'm guessing that the intent is still there. I'll tell you what my fear is. It's outside of the budget. We've got a bunch of elections coming up, particularly Uttar Pradesh in March. We saw the farm laws being kind of reversed a few weeks back, what looked like as a political response to upcoming elections and maybe beyond. If there is a weakness in the performance from the ruling party, does that test the ability and the willingness of the dispensation to put the political capital behind tough economic decisions like privatization, labor law change notifications, and therefore do reforms get tested? I think that's the question to really ask. In terms of markets, otherwise, I guess, look, I'm going to pick up one point you made earlier, Mitali, which is around demand stimulus, and Sajid spoke about it as well. I'll tell you what my problem with demand stimulus is. Yes, I understand there is a lot of problem in the bottom of the K, and therefore people need a rural, urban employment guarantee scheme, etc. as well. The problem is every time we create money through the fiscal route or through any route for that matter, we see money supply going up, we see consumption going up a little bit. And guess what? We don't see manufacturing going up. We see imports going up instead, and we see inflation going up. It goes back to the issue that I think all of us agreed upon, which is our inability to create jobs, particularly in manufacturing, has led us to a situation where even if you trigger demand, it creates either imports or inflation. We are seeing vestiges of that right now. By the way, for 11 months of 2021, our trade deficit with China is at $57 billion, a record high. It looks like for the full year, we're going to cross all records of the previous years. Same old problem. Create money, create some kind of consumption demand, and it goes towards imports. So to me, the question is not how much of demand stimulus does the government create. It will create some across central and states. The point is, do we have a supply side response which is adequate in terms of creating jobs and output in this country, which is higher than the demand which is stimulated? So far, we've failed on that, Mitali. And to me, between the budget and the policies beyond, that is going to be the key denominator. Do we create jobs and output in this country more than the demand that we stoke?
Yeah, no, absolutely, Anant. And if there's any one half of the population that we have failed incredibly so, it is the women. I mean, the fall of the workforce for gender has just been stunning, even by the numbers that we have for overall labor. We have about 10 minutes, so this is simplistic, but let me do this and go around the table again and ask you for even two things that you think would make you say, okay, there's a lot of potential going in what the budget has set out, at least by way of intent. The rest will follow through in the year. Dr. Ranade, let me start with you. Two things that you would like to hear and would signal to you that, we've got our shoulder to the wheel.
This is a very tough one, Mitali. It's not fair to put me up front. But anyway, I think I look for some signs of fiscal consolidation. Let me say that this consolidation versus growth is a false dichotomy. Actually, if you have consolidation, it leaves enough room for loanable funds to go to the private sector, which can cause growth. So actually, consolidation and growth go together; they're not opposites of each other. So I will be, I'll be looking for a number which is hopefully, not very fiscally very aggressive. The second thing I'd like to see is some effort towards improving India's tax to GDP ratio. We are among the lowest in the world, and tax is clearly a budget issue, and we should find a way to improve our tax to GDP ratio, especially direct taxes to GDP ratio. So those are the two things I look for.
Okay. Lekha, maybe I'll turn to you next in terms of what you'd like to hear in this budget.
Of course, investment in health. It's primarily this pandemic. So investment in health. Last time, of course, there was announcement, but we are not clear that how it's going to work. So we have increased to 0.8% of GDP, but still below 1% of GDP, the public investment in health sector. So I look forward to some announcements related to that in this budget as well. And second is, of course, fiscal consolidation can be medium term. And, I respectfully disagree with Ajit that I do believe that, normalization and fiscal consolidation, this moment could be detrimental to the growth recovery. So that excessive deficit procedure can wait maybe 2026. So I do feel that we need to have the narrative of high fiscal deficit in upcoming budget as well. And fiscal consolidation, that excessive deficit procedure, she can of course give a signaling towards that, but not instantaneously. Yeah.
Okay, great. The great thing about having economists not agree with each other is that nobody screams and nobody leaves the TV studio. Sajid, your turn next. What do you want to hear? The two things.
Mitali, in the spirit of disagreement, let me say I'm a little bit more hopeful. I'll just make one point before I get to the two things I'm looking for. I'm a little bit more hopeful than Anant on the supply side response, for a simple reason that over the last 10 years, we had this twin balance sheet problem, and there was a lot of deleveraging that corporates had to undergo. So they were unable to respond to demand impulses, which led to higher inflation and higher imports. But the one big positive of the last 4 or 5 years has been there's been significant deleveraging. Corporate debt to GDP is back at the 2004-5 levels. So I think the private sector is ready and willing to invest. The problem today is demand. Utilization rates are in their 60s. So therefore, I think if there is visibility on demand over the next 3 years, either domestic or external, we may well get a supply side response, at least from large corporates over the next few years, which will be job creating. Of course, MSMEs is a whole different challenge that we need to talk about. So with that backdrop, what are the two things I would look for? I would look for quantum and distribution of expenditure. I think there's about almost 1% of GDP in higher subsidies that will roll off this year compared to last year, given extenuating circumstances then. 0.5% of that can be used for consolidation, but there will be another 0.5% that can be deployed towards expenditure. So, health, education, infrastructure, supporting certain elements of the informal economy. I would look for that. The second is, one thing we must complement last year's budget was on the tax front, there was a lot of realism, both on nominal GDP and tax buoyancy. So I would look to that. I think bond markets will look to tax realism to see if deficit numbers will be met. And from a growth perspective, I'd look at the distribution and deployment of additional expenditure.
No, you're absolutely right on the MSME, Sajid. It's a whole other conversation. In fact, I think this time round, industry bodies have actually said, look, we don't want anything else, but at least pay our dues. Pay what is due to the MSMEs, clear all their backlog, give them some capital to work with when they're going through a third wave of the pandemic. Yamini, your top two. And as parents and as economy watchers, I'm hoping you have on your list what we have really been burning our hearts over, which is the situation with education.
Absolutely. Let me first say that foundationally, a budget is meant to be a statement of the macro fiscal position of the government. I think that last year the government made significant steps forward. As Sajid said, a realistic assessment of where we were. I think it'll be helpful to be a little realistic about our disinvestment proceedings too. Year on year on year, we've been, and that affects the overall fiscal math and it affects government expenditure. So let's get real about what we can and how much we can spend, how much we can sell in order to be real about how much we can spend and what our real fiscal deficit is going to look like. 1 lakh crores not coming into the bank is a significant hole in your math. The second expectation, of course, I think is for the budget to be realistic about the realities of the pandemic. And therefore, I don't think we should hope for less roll off of or roll down of spending on subsidies. Narega public distribution system is going to require elevated spending. And we are going to require a lot more elevated spending on school education. As you can see, my children need to be in school right now, but they're here. We need to open schools. And once we do, we need to deal with the challenge of foundational learning, especially in primary schools. That's going to require a lot more spending. That spending will have to come from a combination of Government of India, so more money into Samagra Shiksha, but also a more realistic devolution to state governments, because ultimately the rubber on health and education and capex infrastructure hits the road at the state level. So ensure that at least you're transparent and stick to your targets on fiscal devolution to states. No cesses, please, in that.
Anant, you have the privilege of the final word. You get to pick your two as well.
Sure, I'm going to give more than two, Mitali. I'm an
Okay.
armchair professor, so I can afford to give a long list. To start off with, on Sajid's comment, that's a good fun of having economic discussions and adda, as we call it in Calcutta, which is, we can have for every economist as an equal and opposite economist, and they're both wrong, by the way. So, all good fun. But I think the starting point is I wish amongst us commentators, we agree and understand that while things like the fiscal, the budget and the monetary policy, these are all important catalysts. The main bottom line really is the real economy, and the bottom line is, do we create enough jobs especially in the MSME sector? Do we give that because 85% of the workforce is in informal sectors, right? So we need that to come up for the economy to come out. If we get our jobs and output right, frankly, everything becomes easy on monetary and fiscal policy. That's a bottom line I wish to take away. But in terms of the catalyst itself from the budget, first, the last year, the good part of the budget was they actually pushed up capex quite a bit. So from 4.2 to 5.5 lakh crores. And they tried to keep revenue expenditure, growth less. I hope that trend continues. And I know it's a contentious topic, but I do like this point about trying to put more money into capex. To the point that Yamini and Dekha made about education and healthcare. Absolutely. I'm hoping to see, of course, a lot of the spending comes from the states, but I'm hoping to see the central outlay also for health and education go up. It doesn't matter what the fiscal deficit, please push up that spending. I think it's absolutely worth it. Specifically, facilitation that I'm hoping to see, a glide path on what are we going to do with public sector banks. Are we going to bring them under Companies Act? Are we going to mull privatization? Two of them have been supposed to be done. Beyond that, as well as will we move along on that. Likewise, on the point I made about index inclusion, I'm hoping that index inclusion happen. That brings in a lot more of stable flows coming into the country. We need external savings. Things like cleaning up the power sector. We've kicked that can down the road a lot of times. I'm hoping that something gets done there. All these will facilitate and hopefully make the PLI and the NIP, the National Infrastructure Plan, and the production incentive work. We need all of this to work to create jobs and output in this country, which frankly is the common denominator for all our problems.
Yeah. No, thank you all. Fantastic points from all of you. I think as a journalist, I would just add one more, which is not necessarily pinned to the budget, but I really, really hope to see more data on what's going on with joblessness. Let's stop dissing CMI or whatever data is available. More data on school dropouts, more data on what the health situation is. Household, we just don't have enough data to understand what's happening, which is why so many of us are talking at cross purposes. But thank you very much, all of you. I deeply appreciate your time, your insight, your frankness really on the situation. And I hope to see some of all these checklists crossed on the 1st of February. Thank you very much for joining in. To our viewers as well, thank you guys for joining in. In about 15 minutes from now, we have a keynote that's coming up from Dr. Vivek Debroy, so do stay tuned from that. But for now, from the Mint team and from me, goodbye.
Thank you.
Bye-bye.
Thanks all.
Bye bye.